Your credit score controls way more than you probably think, and today we're going to show you exactly why. Welcome to this explainer. Today we're taking a documentary-style deep dive right into the hidden mechanics of American finance. We're going to peel back the layers of a system that silently hums in the background of all our lives, constantly influencing our options, our opportunities, and ultimately our bank accounts.
So picture this scenario for a second. Two people can earn the exact same salary, live in the exact same city, and want the exact same car, but one of them can end up paying thousands of dollars more for it. Crazy, right? Why does that happen? What invisible force creates such a massive difference in the cost of living for two otherwise totally identical Americans?
Well, it all boils down to a simple, heavily guarded, invisible price tag that literally dictates this cost difference. A simple, three-digit number.
Okay, let's dive into this and look at what that actually means. In the US financial system, your credit score is basically a three-digit number representing your creditworthiness and, frankly, your overall likelihood to repay debt. Lenders use this exact number to evaluate the statistical risk of loaning you money. It was introduced in its modern form back in 1989 by the Fair Isaac Corporation, which, by the way, is why you always hear it called a FICO score. And since then, it's become the ultimate financial first impression. Typically ranging from 300 up to 850, this single metric completely dictates how the financial world perceives you.
Section 2. Why credit controls everything. The reach of your credit score is honestly immense. According to consumer data from Experian in 2023, the vast majority of American adults carry some form of debt, meaning almost every major financial milestone you're ever going to cross is heavily governed by the system. Sure, a high score gets you the absolute best credit card offers with those premium travel and cashback rewards we all want, but its impact goes so far beyond just credit cards. It dictates the interest rates you qualify for when you apply for an auto loan, or a mortgage to buy your first home, or even a personal loan for some unexpected emergency. But here is where it truly controls your everyday life. Even if you never borrow a dime, landlords are running credit checks to decide if they'll even let you rent an apartment. Utility companies use it to decide if you need to hand over a massive cash security deposit just to turn on your lights and water. And get this, in many states, insurance companies use credit-based insurance scores to help figure out your monthly premiums for auto and homeowners insurance. Basically, if you have a lower score, you're inherently seen as a higher statistical risk, which means you are systematically charged a premium just to participate in the modern economy.
Section 3. The true cost of credit.
Now, what's really interesting about this slide is seeing the actual math in action. Let's compare two Americans borrowing the exact same amount of money just to see the real dollar penalty of a low score. Let's say they both need a $30,000 auto loan paid back over 60 months. Person A has an excellent credit profile and easily secures a 5% interest rate. Person B, on the other hand, has a poor credit profile and gets stuck with a 15% interest rate. Let's look at the math here. Person A has a monthly payment of about $566. Person B's monthly payment jumps to $713. Now, maybe that doesn't seem like a world-ending difference month to month, but over the 5-year life of that loan, Person A pays just under $4,000 in total interest to the bank. Person B pays over $12,700 in total interest. That is a shocking difference of nearly $9,000. That is $9,000 vanished into thin air purely because of a three-digit number. Just think about the opportunity cost right there. That $9,000 is a down payment on a starter house or a fully funded individual retirement account just entirely wiped out. It's the same car, the same loan amount, but a drastically different cost of living. Let's move to and see how this builds in Section 4. What builds your score? We're going to demystify the so-called black box of credit and look at the exact algorithm. According to the standard FICO scoring model, which is used by the vast majority of top US lenders, your score is broken down into 5 very specific slices. First up, 35% of your score is your payment history. Do you pay your bills on time? This is the largest single factor because to a bank, your past behavior is the absolute best predictor of your future behavior. Missing even one payment sends a huge red flag to the algorithm. Next is 30% for credit utilization. This just means how much of your available credit you're currently using at any given time. Think of it like this. If you have a $10,000 overall limit across all your credit cards and you're carrying a $9,000 balance, you look incredibly risky. Even if you're making your minimum payments on time every single month, lenders see that you're nearly maxed out, and that signals potential cash flow problems. Then, 15% is the length of credit history. Lenders love predictability. The longer your accounts have been open, active, and in good standing, the better it is for you. Finally, we have 10% for new credit, which dips slightly when you apply for or open too many new accounts all at once because it kind of makes you look desperate for funds. And another 10% for credit mix, which rewards you slightly for successfully managing different types of debt, like balancing revolving credit cards with fixed installment loans.
Section 5. Fixing common credit mistakes. So let's talk about the everyday traps that can quietly ruin your financial profile. Missing a payment by just 30 days can tank an otherwise perfect score practically overnight, and it can take months or even years to fully recover. Maxing out your credit card spikes that utilization ratio we just talked about, heavily dragging down a full 30% of your total score. And applying for way too many retail store cards during the holidays? Yeah, that definitely dings your new credit metric. But here's a wildly counterintuitive trap that catches millions of people. Closing an old account. Imagine you finally pay off that high-interest college credit card. You proudly cut it up, you close the account, and you're thinking you're being incredibly financially responsible, right? right? However, the algorithm actually sees that as a negative. Remember that 15% for length of credit history? When you close your oldest card, you eventually wipe out a massive chunk of your proven track record. Worse, you immediately lower your total available credit, which mathematically increases your utilization ratio. Also, ignoring your credit reports is a massive mistake. According to consumer watchdogs, errors happen constantly, from mismatched names to literally fraudulent accounts. If you aren't checking your own file, you are literally paying higher interest rates for someone else's mistake.
So the crucial point is that navigating this deliberately complex system requires a few highly effective habits. Here are the practical, educational steps for repairing and maintaining a really healthy profile in the US. First, monitor your credit reports regularly. Thanks to changes made post-2020, you can now check your reports for free on a weekly basis at annualcreditreport.com to actively catch and dispute errors. Second, set up automatic payments for at least the minimum due on every single account so you never ever miss a payment. You've got to protect that 35% payment history at all costs. Third, keep your credit utilization extremely low. While conventional wisdom says keep it below 30%, keeping your balances below 10% of your total limit is the real secret for unlocking those top-tier 800+ scores. And fourth, maintain your older, no annual fee accounts. A great trick is to put a small recurring charge on your oldest credit card, like a $10 streaming subscription, and set it to autopay just to keep that positive, on-time history flowing into the algorithm month after month.
Section 6. Credit is not wealth.
We absolutely need to clearly separate the illusion of wealth from a high credit score. Having an 800 credit score is fantastic for sure, but fundamentally, it just proves that you are an excellent debt manager. It proves you're highly trusted by massive banking institutions to borrow other people's money and pay it back with interest, but it doesn't mean you actually have any money of your own. Being financially wealthy means being a wealth builder. It means owning assets, like investments, real estate, stocks, or businesses, and building true net worth. A great credit score makes borrowing cheaper and life much smoother. It completely prevents you from wasting thousands of dollars on excessive interest. But guys, you cannot retire on a credit score. An 800 FICO score isn't going to pay your grocery bill when you're 75 years old.
And this brilliantly illustrates our final takeaway. Your credit score isn't wealth, but in America, it can entirely influence how much your financial life costs. It's the ultimate gatekeeper to affordable borrowing, determining whether you get to keep your hard-earned money or are forced to hand it over in the form of massive interest payments to a bank. So ask yourself, are you spending your life optimizing your debt, or are you actually building your wealth? If you want simple explanations of how money really works in America, subscribe to Global.